Chaos, fear, and uncertainty. That is what retail investors are feeling right now after the heavy drops that we have seen in the last few days and hours. With XRP losing key support levels, Bitcoin falling to the 110,000 range, and Ethereum also moving down. In moments like this, the first question is always the same. What comes next, and why are prices falling? In this video, we're going to slow down the panic and explain that what is happening now is part of a very strict and deliberate plan. It is a strategy that involves Donald Trump, Jerome Powell, and the Federal Reserve, and it could set up the conditions for the next explosive bull run later this year. Now, let's begin with the key trigger behind this current move. The latest U.S. jobs report released last Friday came in much worse than expected. It even revised down the previous job creation figures for May and June, meaning that the labor market is significantly weaker than previously believed. This single report has placed Jerome Powell and the Fed in a very difficult position. After months of delaying interest rate cuts, they are now under pressure to act quickly because the economy is showing clear signs of strain. Historically, when this type of negative surprise has happened in the past, the Fed has been forced to hold emergency meetings and cut rates earlier than expected. The possibility of such a meeting has increased dramatically since this report that on prediction markets like PolyMarket, the odds of no change to interest rates in September collapsed from 63% to just 22% after the jobs data. That is an enormous shift. This is exactly what Donald Trump wants. His strategy is clear. By putting pressure on Powell to cut rates sooner, the U.S. government will be able to refinance existing debt at cheaper rates and issue new debt at a lower cost. This injects huge amounts of liquidity into the system, and that liquidity inevitably flows into risk assets like tech stocks and cryptocurrencies. This is how the next big bubble starts to form, the kind of bubble we often call a bull run, where risk assets explode to new highs. Add to that the fact that geopolitical tensions between the United States and Russia are increasing again, and you can understand why the macro environment is so uncertain. On top of this, Eric Trump, Donald Trump's son, has come out once again and said the same thing he said back in February of 2025, buy the dips. It is not a coincidence that he repeats this when his father is orchestrating all of these events. While he specifically mentions Bitcoin and Ethereum, this environment affects the entire crypto ecosystem, including XRP, XLM, HBR, and many others. Blockchain analysts are pointing out that something much deeper is happening beneath the surface. We are witnessing a structural replacement in crypto. In the last 2 years, there has been historic activity coming from very old Bitcoin wallets. Coins that have been dormant for 7 years or more are finally moving, which means these longtime holders are transferring their Bitcoin to new owners. This is likely institutional money buying from old retail hands. The important point is that this is not just another market cycle. It is a deep structural change in who holds the coins. These processes take time, as investment committees and institutions meet 4 times a year, and decision-making can take 18 months to 2 years. But the end result is expected to be trillions of dollars flowing into crypto in the next 12 to 24 months. Donald Trump himself has been saying in public that the next 6 months will be amazing. He points to new auto plants, artificial intelligence investment, and massive funding coming into the U.S. economy. This is liquidity, and liquidity is what drives financial markets. When liquidity enters risk assets, it triggers bull markets. If Powell cuts rates, or if an emergency event forces him to cut rates earlier, this will initially push prices even lower, but once the liquidity hits, the markets will surge higher. That we have seen this pattern before. The most notable example is the pandemic crash. Back in 2020, Bitcoin dropped from 9,000 to 3,900 in just a few days, but that crash triggered a flood of liquidity into the system. After that injection of liquidity, Bitcoin went on a historic run all the way to 63,000 and later to 70,000. What looks terrible in the short term can set the stage for the next rally. Another important point is what has been happening at the policy level. Paul Atkins, the new SEC chair, has announced the crypto project with a vision where every asset in the financial system will be tokenized. The White House has released a 160-page digital assets report. New crypto ETPs and ETFs are being approved, and Nasdaq is seeking generic standards to list these ETFs. At the same time, major banks like JP Morgan are partnering with crypto exchanges like Coinbase. The line between traditional finance and crypto is disappearing. All of this is happening while Bitcoin and other digital assets are still far from their long-term cycle peaks. Tools that track long-term market cycles show that Bitcoin, even at 112,000, is nowhere near the red line that marks cycle tops. Some models project possible future peaks at 170,000 to 200,000, and others even higher. Historical averages show that August tends to be a volatile month, but in the big picture, these temporary drawdowns are just part of the cycle. The takeaway is clear. Volatility is part of investing. Markets go through fear, panic, and chaos on their way to the next big expansion. If you understand what is happening behind the scenes, the rate cuts, the injection of liquidity, the structural replacement of old holders by institutions, the tokenization of real-world assets, you can keep your perspective. The smart money is preparing for what comes next. The coming months may still bring uncertainty, but the long-term trend is clear. More adoption, more liquidity, and higher valuations for digital assets.